now to Art Hogan, National Securities, for just a read on, Art, where you think these markets stand here. There was obviously a huge momentum feeling to the downdraft that we saw, and it came off of that resistance point for the S&P 500 at 3550. So just in terms of where you think the market goes from here, let's start there.
Yeah, I think it's interesting. We had a market that got very overbought in the month of August. The RSIs coming into last week were closer to 90 than they were to 80. And clearly, anything above 70 shows you that you're overbought. That was true of both the S&P and the NASDAQ. So we were looking for a reason to take some of the froth off the top of this market. And once that momentum starts moving the other direction, which we saw happen pretty quickly, Wednesday, Thursday, Friday, you certainly saw that continue into the opening action on Tuesday. And I think what is remarkable to me is, as technical as that correction was, it was correcting a technical overbought situation. And both the S&P and the NASDAQ stopped almost exactly on their 50-day moving average and bounced there. So we're really in a market that's not trading fundamentally right now, really trading technically. And I think we're at a period of time where there's as many headwinds as there are tailwinds in this market going forward.
Yeah, and I mean, it's interesting that you note that, because from a fundamental basis, even when we pulled back to that 50-day moving average, you're basically where you were pre-pandemic, as though it never happened, as though the economy on both sides of the border is as it was in January, February. And we, of course, know that's not true. Even if we snapped our fingers and COVID went away today, there is economic damage we have yet to see materialize here. Businesses that haven't gone under, individuals that haven't declared bankruptcy, debts that are coming due. When will the markets, I guess, start to get rational about the fact that we have a downdraft here on the economic front?
Yeah, and I think that downdraft on the economic front only gets worse the longer we wait for a second round of fiscal policy stimulus. The CARES Act 2.0 is stuck in gridlock in Washington, as you know. And without that, all those things you just highlighted, small and medium businesses, unemployed people, are going to be in a lot of trouble. We're going to start to see rents not getting paid and mortgages not getting paid. And the market doesn't reflect that reality. I think the reality the market reflects is we get a second round of fiscal policy stimulus. We get some good news on vaccine readouts in the fall at some point in time. In the first quarter of next year, we start mass production. And by the first half, we've inoculated a good chunk of the population, and things start to get back to normal. The market, obviously a forward pricing mechanism, has to start looking ahead to how much of that are they getting wrong? Are we not getting more fiscal policy? Does the election throw a monkey wrench into this? So I think the S&P 500 is looking at that all the same time. They're looking at a U.S.-China technology Cold War going on right now, and that tit for tat's only going to get worse as we head into the election cycle as well. So plenty of headwinds to be concerned about. I'm glad that sort of short flush out in the market is behind us, at least for the near term. And we saw a 7% drawdown in the S&P, about 11% in the NASDAQ 100. That's normal. That's a normal kind of corrective process. But to your point, the market is certainly a lot further ahead than the economic growth is.
So where are you favoring at the moment, and has it shifted at all? Because we've begun to talk about, moving into kind of the cyclicals at like the early stage of an economic recovery. Can we still say that may be where we are? Oh, absolutely. When we look out to 2021, the sequential economic growth is going to be much better than it was for most of 2020. So we have seen sequentially better economic data, but that's just horrible news getting less bad over the course of all of 20. As we head into 21 and we get beyond some of the things we're concerned about, like a vaccine, for example, I think that releases a lot of pent-up demand for those goods and services that we've delayed purchasing. And I think that economic explosion turns into stronger GDP growth and stronger earnings growth. But we don't know if that's, the first half, second half of next year's business. All the while, we've got a pretty fully priced S&P 500 trading at 20 times next year's earnings. So, yeah, we're in this conundrum where the market has just gotten far enough in front of the economic improvement that, things could go either way. And I think this is the time where we're going to see some of that volatility manifest. And certainly September and October have been pretty bad months for markets historically. I'm curious for your take on what we're seeing in the price of oil and what that reflects about thinking on global growth and demand and which parts of the world might fare better than others.
For a while, it felt like we've had a very strong OPEC plus cartel that was keeping control of production, right? So the supply side response was wise. And the national economic response that we saw in North American supply is just that. If it's not economic, we're going to lay down rigs and not overproduce. So supplies have come down
drastically since the beginning of the year. So that, I think, is important. And demand is gradually picking up. Certainly the demand for hydrocarbons in China is back to where it was pre-pandemic. That's the good news. That's not true for the rest of the developed world. So we're gradually seeing demand pick up, but it's still not matching even those reduced supplies. So for that period of time when we were sort of dancing in the $40 to $45 world in both Brent and WTI, I think that was a bit optimistic. And then Saudi Arabia over the weekend talked about some price cuts, probably getting a little loose around the cartel as to how much supply should actually be out there. And I think that's why we've seen this over the last couple of days, this sort of pullback in energy prices. I don't think it's long term. I think the cartel's done a pretty good job of controlling supplies, but we just need more demand to pick up, and it's just not there yet.
I mean, one thing that would drive demand, obviously, is real progress on a vaccine. We have this, and we should say, very unsurprising, in fact, kind of normal course setback for AstraZeneca in its clinical trials on the path to its vaccine with Oxford. This happens, but are we overly optimistic? Have the markets priced in, thanks to rhetoric from some politicians, that a vaccine is coming sooner than it actually will?
I would say we're certainly overly optimistic. I would say what happened to AstraZeneca happens almost in every phase 3 trial, especially ones that have that many patients in them. So you had one safety to be investigated, to find out what that was. Did it have something to do with the vaccine, or it was just a bit of a coin flip luck that this one-off person in a very large study happened to have an adverse impact? That's why we do phase 3 studies. It's to actually find out the safety of this. And that's why it takes so long to get vaccines out, because we want to make sure they're safe. Giving a vaccine that's not safe to a bunch of healthy people is going to be the worst pandemic than the one we're in right now. So logic would dictate that, yes, the earliest potential readouts we get are sometime this fall. Certainly not before a November 3rd election, but sometime this fall, which then means you go into mass production. And when you're talking about mass production, you're talking about hundreds of millions of individual vaccines to get spread out, globally. So to me, I think thinking that somehow there's going to be a silver bullet in the vaccine sometime in late October, early November is certainly getting ahead of ourselves. The good news is we're working at lightning speed to get there. It just takes time to make sure these things are safe.
It's always great to have your thoughts, Art. We really appreciate it.
Thank you.
Art Hogan is Chief Market Strategist at National Securities.